The cost of higher education continues to rise, making saving for college increasingly important. A tax-favored 529 college savings plan can help fund higher education for children, grandchildren, or generally anyone, even yourself. Studies show that $150 billion was spent in 2013 on tuition alone. Yet only a fraction of that flowed through 529 plans. With just 15% of families using 529 college savings plans, that means investors may be missing out on important tax advantages and the chance to reach multiple financial goals. 529 college savings plans offer several advantages over traditional choices, such as taxable mutual funds and UGMA and UTMA accounts. These advantages include tax benefits, professional money management, and control by the account owner. The tax advantages, in particular, offer a powerful edge. Investments grow federal tax deferred as long as the money remains in the account. And withdrawals are federal tax-free as long as they are used for qualified higher education expenses. In addition, certain states offer state income tax deductions for contributions into 529 plans. That savings can really add up. Plus, 529s are flexible. Anyone can set up a 529 plan, and there are no age or income restrictions. Account balance limits are high, and separate accounts can be opened for an unlimited number of beneficiaries. 529 plans may be especially ideal for grandparents, many of whom want to help with their grandchildren's college expenses but aren't sure where to begin. A recent Legg Mason study found that grandparents want to take a more active role in their grandchildren's lives, largely in the form of helping pay for college expenses. However, fully half of grandparents are not saving to help out, simply because they are not sure how to start. Grandparents seem highly motivated to contribute, mainly because they have the financial means to help or because they want to leave a legacy behind. Given those drivers, grandparents may prove to be the wave of the 529 future. Our study showed grandparents especially liked 529's flexibility and control. For example, if a grandchild decides not to attend college, the beneficiary can be changed to a new beneficiary without penalty, providing he or she is a member of the family. And 529 assets can be applied not only toward tuition, but also to room and board, books, and other qualified education expenses. What's more, because an account owner maintains control of the 529 assets, he or she can withdraw the funds and close the account for any reason at any time. This does trigger federal income tax and an additional 10% federal tax on the earnings portion only. That said, it's still a very handy out clause in case of a financial emergency or for any reason. For grandparents, 529 plans offer the best of both worlds, providing an educational legacy while potentially reducing estate taxes. Here's how it works. You can use contributions to 529 plans to reduce the size of your taxable estate. That's because 529 contributions are considered completed gifts to the beneficiary. Grandparents have a variety of ways to gift. They can make annual contributions up to $14,000 or $28,000 for single or married respectively, free of gift tax. Or alternatively, they can make a lump sum contribution using the 5-year forward gifting provision. This provision allows you to make 5 years' worth of contributions in a single year. After the 5 years have passed, you're eligible to make another 5-year forward gift, funding the 529 plan up to the maximum allowable account balance limit for that state. This chart shows an example of the maximum contribution per child for 2 married grandparents. They can make a 1-year contribution of $28,000 with a gift tax exception. They can make the 5 years' worth of contributions, $140,000, through the 529's 5-year forward gifting provision. Again, all the contributions are removed from your taxable estate. Just bear in mind that if either grandparent dies before the end of the 5-year period, a prorated portion of that person's contribution, less any earnings, will be included in the value of his or her taxable estate. When considering a 529 plan, one common question is, why not make a direct payment? That is, just write a check to the college. Besides missing valuable tax benefits, writing a check directly to the college is not the optimal way to gift. With a 529 plan, the funding happens now, not when the child's in college, and so removes the assets from the taxable estate now. Furthermore, it removes the risk that the grandparents pass away before the child goes to college, which would leave all the assets in the estate. Direct payment checks often can be used only for tuition, not for room and board, books, or other expenses. 529 contributions can be used for all qualified education expenses. Direct tuition payments from family members have a higher impact on a student's eligibility for financial aid than a 529, because these direct payments are considered income to the student. Let's look at a case study of what happens to 529 funds if a beneficiary decides not to go to college and if the funds are needed for non-qualified expenses. Meet Jane and Bob Moore, grandparents with 2 teenage granddaughters. At their financial advisor's suggestion, they open up 2 529 plans, one for each granddaughter, in either Jane or Bob's name, as there can only be one account owner per 529 account. Let's call them Annie and Bethany. After 2 years of college, Annie decides to pursue other interests. So Jane and Bob simply reallocate those funds to Bethany. Of course, this probably creates more funds in Bethany's account than she needs. Jane and Bob soon experience an unforeseen health event that generates large medical bills. Fortunately, they can take back the unused portion in Bethany's account as a non-qualified withdrawal to pay off the medical bills. As mentioned before, as a non-qualified distribution, they would pay the account owner ordinary income tax and a 10% additional federal tax on the earnings portion of the distribution. When you consider your 529 options, think about Scholar's Choice, one of the leading advisor-sold 529 plans nationwide. Scholar's Choice is consistently recognized by SavingForCollege.com. With Scholar's Choice, you gain the advantage of portfolio management expertise by QS Legg Mason Global Asset Allocation. You gain a broad range of investment options, including age-based or static allocations, individual portfolio options, and a cash reserve option from multi-manager portfolios, including ClearBridge, Western Asset, QS Battery March, Brandywine, and Royce. This is all offered with a pricing structure that's among the most competitive in the industry. Unit Class A maximum sales charges are 3.5%, and Unit Class C carries no upfront sales charge or back-end CDSC. And annual asset-based fees are among the lowest among advisor-sold 529s. For all these reasons, Scholar's Choice should be the foundation for your college funding strategy.